Welcome to Upthinking Finance, a podcast that offers a unique and discerning view of economics and financial planning. Here is your host, Emerson.
Welcome to another episode of Upthinking Finance. Philanthropist Shelby M.C. Davis once said, "Invest for the long haul. Don't get too greedy and don't get too scared." The energy infrastructure space has occupied a place in our clients' retirement income portfolios going back to 2014. And so, given that it's a big part of our practice, I thought it'd be a good idea to revisit the sector and the fundamentals and get a bit of an outlook from an expert in the industry. Today's guest is Simon Lack. He's the managing partner of SL Advisors LLC. SL Advisors manages investments in the midstream energy space, including the Catalyst Energy Infrastructure Fund. Simon has nearly 46 years experience in the investment management industry and is also the author of 3 books. Simon is a CFA chart holder and is a board member of the CFA Society in Naples, Florida. So it's my pleasure to welcome, coming to us from Westfield, New Jersey, Simon Lack. Simon, thanks for joining me today.
Great to be on, Emerson. Good to see you.
Yes. So I think, we've had the last 4 years prior to 2025, we had some really a good run up in the industry for a lot of reasons. But I think it would be nice to start with a little bit of history. My exposure goes back in the MLP sector to about 24, I call it the MLP sector, I should say the midstream energy space, energy infrastructure, to 2014. So maybe if you don't mind, just can you go through kind of a summary? Because it's been a bit of a roller coaster that bring us up to where we are today.
Yeah, I mean, the sector was originally created in the late 80s under the Reagan Tax Reform Act and allowed energy businesses to set up as master limited partnerships or MLPs, so they didn't pay tax. And so that was great, but they gave you a K-1 instead of a 1099. So you got more complicated tax reporting, but more of the profits went to the investors. So for a long time, the sector was really invested in by high net worth investors, people, old rich Americans, people who are willing to take a K-1 because they have an account to do their taxes, and they like the sort of tax deferred return. So it continued like that. It was really an income generating sector. And then we had the shale revolution. And the shale revolution was a fantastic thing in so many ways. It certainly took America to energy independence. It created more need for energy infrastructure. And as is often the case, there was too much investment, overbuilding. And 2014 was really about when that was beginning to become clear. By 2015, the market had peaked. There was stranded assets and pipelines that wouldn't be fully used. And so went into an extended downturn. And that really only finished during the pandemic, when there was a lot of liquidation and companies really brought down leverage. And since then, we've had a lot of great years since the pandemic. This year, 2025, is weak because this is a growth year and everybody wants AI stocks. But from 21 through 24, those were 4 really strong years.
So not to harp on the downturn, because clearly the timing of me getting, introducing clients to this sector wasn't perfect. But there was a lot of consolidation. There were dividend cuts. I was trying to remember the name of the one company that was kind of the bellwether that sort of began.
Well, Kinder Morgan.
Yes.
Kinder Morgan kicked that off. And to be honest with you, they still haven't fully recovered. So the typical MLP model consisted of an MLP and then a general partner, which basically controlled the MLP. It was very much like a hedge fund manager and a hedge fund. And when we first began investing in the sector, we focused on the general partners, which were like the hedge fund manager, and not the MLPs themselves. And that's because in the hedge fund business, everybody knows that the hedge fund managers always get rich. The clients maybe do, maybe don't. So we invested with the general partners of MLPs, and that was a great place to be. But Kinder Morgan was using their MLP to basically do more and more construction and raising capital for it. And they overbuilt and they wound up having to cut their distribution. Now, the problem with that is that their investors were older, wealthy Americans who wanted the income. They were there for that stable income. So to cut the distribution on that investor base was a really sort of a big own goal. And so as other firms did the same thing, those investors really sort of pulled back and said, boy, I thought these distributions were really secure and stable, and they're not. And so a lot of MLPs then started converting to be corporations where they'd have a much bigger set of potential investors. And Kinder Morgan is still never come back from that. They still have a distribution that's a lot less than it used to be. I think a little over half of what it was back then. And the stock price still hasn't recovered. Other firms have done a lot better. Kinder Morgan sort of led the way in how not to treat your investors all those years ago.
Well, okay, so here's a question which kind of gets ahead, but you sort of mentioned, from the bottom of COVID up and through, the end of last year, a really, really good run up in the sector.
Right.
But I guess my question is, and this is more from the advisor side of the desk, but it seems as though that the Kinder Morgan decision, but has the retail investor really come back after that? I've heard this from other people in this sector that once the dividend got cut, there was a portion of the population. I mean, this used to be viewed as kind of a stable, low risk,
Right. Yes.
energy, income source, and that completely blew up. But and then of course advisors, people in my role, generally speaking, tend to want to, I mean, I hate to say this, but there is a element of the path of least resistance. And so why go back into something where if you look at a 10-year track record at a certain point in time, you can, you see all these problems when it's easier just to advise people to go into a growth fund with, the Mag 7 or something. So,
yeah, well, I think, the retail investor has come back, but not the same person as before. So there's a whole sort of generation of investors who are really soured on this.
Okay.
Because with Kinder Morgan, not only did they cut the distribution, but then they combined their MLP with their general partner, which was Kinder Morgan Inc. And without going into a lot of messy details, it was a very bad tax outcome for long-term investors in Kinder Morgan Partners, which was acquired. And so people went through, those investors had a distribution cut, and then they had a tax bill, which they didn't want. So, I don't talk to them anymore because it's a long time ago. But in the years following that, I would often run into somebody who was sort of a former Kinder Morgan Partners investor who was sort of, still getting over the shock. But a new set of income-seeking investors have come along over the years. And so, there's a decent amount of retail participation in the sector. I think it's still a great opportunity. But yeah, you do have retail investors who are back in.
Oh, that's good. Okay. So I guess let's talk about, I get a chance to watch your material and you've got a lot of really positive things to say about the sector. And so I'd be curious, let's maybe just get into some of the fundamentals of what's going on now.
I mean, we like the gas story. So we're biased towards natural gas. And we decided that quite a few years ago because this sector had three big headwinds that it was up against for a long time. You had the energy transition, so all these fears that you'd have stranded assets. You had the overbuild from the shale revolution and the distribution cuts. And then you had the pandemic and demand destruction and oil briefly going negative. And so they had these three sort of big headwinds. And so with the energy transition, we thought about it a lot. We read about it, talked to people, and it just seemed to us that gas was not going to go away. Oil is a transportation fuel. And so that could be somewhat subject to public policy to say they want to be biased towards EVs or against. But gas doesn't have any easy substitute. And what America has achieved, which I think is fantastic, is we've reduced emissions around 15% over the last 15 years by not trying very hard, by moving from coal to gas, because gas is so cheap here. And so gas, it's hard to move, it's expensive to move, so therefore the infrastructure gets long-term contracts when it's built. So you have a lot of cash flow visibility. So we really like the gas story. And today, I think that's absolutely the place to be because you've got two big demand drivers. You've got LNG, liquefied natural gas exports. America's the biggest exporter of natural gas. We have so much cheap gas here, much cheaper than in Europe or in Asia. And the price difference is easily big enough to cover the cost of turning that gas into near liquid and putting it on a special tanker and sending it overseas. So you've got that driver of demand. And then you've got data centers. And data centers need electricity. They need it now. And it's not going to come from renewables. I mean, these data centers need power all the time. I mean, virtually 100% of the time. There was one great statistic from Morgan Stanley said that data centers today, the new ones, need to be up 99.99999% of the time, 99 with 5 nines after it, okay? So that means they can be down 3 seconds a year. That's basically what that math means, right? 3 seconds, okay? Solar and wind run 20 to 35% of the time. It's no chance that you're running a data center on solar and wind. I mean, all you hear is the data center want redundancy. They want to make sure that if this power source goes down, they'll still have that one. So you've got these two big demand drivers for gas, which are LNG exports and the AI revolution in data centers. And so I think that makes it a really exciting place to be. I mean, we have so much cheap gas and we're going to be using it to win at AI.
All right. So let me ask you this. I'm going kind of back and forth here, but what accounts for the run up from, the bottom of COVID until, the end of last year? And I'm like you, I'm an optimist going forward. To me, this is one of the few areas that actually makes sense long term for a bunch of reasons. But I mean, what was it? Simply just think there's a point where something gets too cheap? I mean,
well, I think you had those three headwinds, right? The shale overbuild, the stranded assets filled with the energy transition, and then demand destruction. And they all sort of culminated. And then you had this other really sort of sinister aspect, which is these closed-end MLP funds, which I think are a very bad vehicle because they use leverage, right? And it's actually a very arrogant thing because the industry operates on 3 to 3.5 times debt to EBITDA. That means that Moody's and S&P and the CFOs have all kind of agreed that that's the right place for an investment grade company. And the portfolio manager of a closed-end MLP fund is basically saying, you know what? I think that's wrong. I think we should be running at 4.5 or 5 times leverage, and I'm going to add leverage to do that. So it's a very sort of intellectually arrogant thing to do. And the problem with leverage, as you know, is that when things go down hard, you have to sell when you'd rather not sell. So the low in the market in March of 2020 was really caused by these MLP closed-end funds having to liquidate. And the good news is that although they took the market down at the very end, they lost a lot of capital and they're not big enough to cause any damage again in the future. So from that point, probably anybody who's going to sell had sold out. And the sector was ridiculously cheap. And the operating performance was not even close to as bad as the stock prices suggested. And so we had that sort of steady run up and, culminating with the last year when, 40 to 45% returns were broadly across the sector. So that was a great run, but it obviously took a real sort of washout to set the stage for that 4 years earlier.
Yeah, when I explain this to clients, I think I describe the sector, in my opinion, as probably the cleanest on the books. As all the, like you just said, all the problems, it seems like have been washed out. And there's really nothing left, when you have companies that I think as a whole are using their money to make distributions and buy their own stock back and are looking to, I think, expand and grow. Is that a right way to explain it?
Yes.
That's a good place to be.
And a lot of it is now self-funded growth. I mean, the old MLP model, 10 or 15 years ago was one where the MLP would issue equity and debt for each new project. Now is funded internally. Nobody does a secondary offering. And yeah, they'll issue debt, but only to roll over existing debt or just as their EBITDA grows, so their leverage isn't going up. So it's a self-financing model. There's a lot more discipline around the returns on invested capital for growth projects. And so, yeah, I totally agree with that. Leverage has come down. Used to be 4 to 5 times debt to EBITDA, 3 to 3.5 times now. And so it's it's much less correlated with oil. It used to be that when oil moved, this sector would move. There was never any real reason for that to happen because pipelines, as you know, they are toll models, right? They just want the volume going through. They don't really care if oil or gas is expensive or cheap. They want the volumes going through. But nonetheless, oil price reflects energy sentiment, and that would affect this sector. That doesn't happen anymore. Last year oil was down, we were up a lot. So the reduced leverage, the stronger balance sheets have really done that. So I think the sector's in as great shape as I can remember. I mean, it really is. It's got great growth drivers, strong balance sheets, very disciplined CapEx decision-making process, great distribution coverage, and it's not over-invested. I mean, everybody wants to own growth stocks, right? Value's out of favor. Yields were attractive. The Fed's cutting rates. So, there's a lot going for it right now.
You brought up a point I was going to get to, the correlation, because that was the thing in the beginning that never really made sense to me, was the coupling of the as you said, oil prices in the sector. Because the other, I mean, to me, and I mean, it's a simple way of looking at it, but the infrastructure is leased. I mean, it's contracted out, right? So volume, I mean, prices of whatever's going through the pipes is kind of irrelevant, I think. I mean, is that? I mean,
That's very largely true. I mean, it's and many pipelines operate and LNG export terminals on a take or pay basis. In other words, you buy 50,000 cubic feet a day of pipeline capacity, and you're paying for that capacity whether you've got gas to put in it or not. It's even more true with the LNG export terminals. I mean, Cheniere, who's our biggest exporter of liquefied natural gas, they've got 95% of their capacity sold out through 2035, 10 years from now. So they know the cash flows they're going to generate on those assets for the next 10 years. So it really doesn't matter to them what the price of gas does. They're going to get those liquefaction fees, and they have all investment grade counterparties for that. So that is the case. And so it was never... the CEO of Williams Companies, which is a very big natural gas pipeline company, is not sitting there thinking about the price of crude oil. But Williams is a component in XLE, in the S&P Energy ETF. And so when oil moves, that ETF moves, and it might well drag Williams with it. So, that creates opportunities for people who want to try and fade that a little bit.
Yeah. So here's a question. So I did notice the decoupling like you described, pretty much a couple of years ago. It seemed like there was a separation. And as you mentioned, last year was clear evidence. But
Right.
is there now some kind of a correlation? Because you mentioned the AI connection. I mean, that's my words, but these data centers, is now there a connection between, are we now linked to the movement in that sector, in sort of a similar, and I'll call it dysfunctional way?
I mean, not so much to the price of the commodity, but let's just say we came in tomorrow and there was, credible reports that we need a lot fewer data centers than we thought. Obviously, the AI sector would get hit, but pipeline companies that have been planning to provide gas to data center power stations, yeah, I'm sure they'd probably get hit on something like that. But that's sort of a volume story. Okay, there'll be less volume demand than we thought there would be. I mean, the price of gas, which is really what they're going to use, that varies hugely around the world. I mean, it's $4.50 a million BTUs here. It could be $11, $12, or $13 in Asia and in Europe, because it's expensive to move. The cost of moving oil is a small percentage of the price of a barrel of oil. Oil's like, say oil's $65 and it might cost you $5 to move it across the Atlantic. But gas is $4.50 and it might cost you $4 to move it to Europe. So as much of, you spend as much again as the gas itself. So you get these big regional price differences in gas. So there is no sort of global price of gas to affect sentiment in the same way there is for oil. So we just have so much gas. So yeah, there's, I think there's some exposure to if you had real bad news on data centers. But this sector has really moved sideways to even down a little bit this year, even while cash flows have been growing. So it's just gotten cheaper over the last 12 months.
And how do you account for that? I mean, if you had to just, I mean, I'm curious because, people, again, fundamental analysis only goes so far, I mean, and then the market has a mind of its own, it seems like sometimes. And is it just, profit taking, money shifting out of sectors from one to the next?
Well, I think value's been out of favor. So not just for midstream energy, but any value sector up until maybe the last few days has really been out of favor versus growth. So there's a bigger thing there than just midstream. Specific to midstream, there's been some analysts who have been saying, we're going to have too much LNG capacity, that we're building all of this capacity to export liquefied natural gas, and there just won't be the demand. We're going to double our ability to export gas by 2030. Will there be the buyers? Well, there's two answers to that. One is that companies like Cheniere are not taking delivery of the gas. They're just offering to chill it. So it doesn't really matter to them if demand for gas is high or low. They've got contracts with people who said they're going to buy it. And the other thing is that regasification. So when gas gets moved on a ship, it's chilled it goes through liquefaction. It's reduced about 1/600th of its normal volume. So it's very compressed, goes on a specialized tanker, sails around the world to Europe or Asia, and then it's regasified, turned back into gas to go into the gas system. And so there's regasification terminals on the other end of that, right? So the capacity of regasification is also growing. And it's roughly 2 times the capacity of the LNG side. So in other words, if all of the LNG terminals in the world were operated at 100% capacity, they'd only use half of the regasification capacity that's on the other end of that. So I don't think there will be an excess of LNG supply, because I think a lot of countries in the world are getting ready to buy it as well. But even if there is, the midstream companies involved in that, it's not their gas. They're just charging a fee to chill it, and they've got long-term contracts to do that.
So I probably should have asked you this question in the beginning, but the reality of it is the energy infrastructure, that definition's broadened out, hasn't it? I mean, it used to be simply, in my mind, it was, pipelines and storage, but there's a lot more to it now. Is that right?
Well, certainly you'd add LNG export terminals to that. That would be infrastructure. There is gathering and processing. So, that's a different role at the wellhead itself. Infrastructure companies will get involved in helping to process them. You don't get pure oil or pure gas out of the ground. It comes mixed up with other impurities. Natural gas, which is methane, can come up out of the ground with ethane, with propane, which are natural gas liquids, with water, with other things. They all have to be separated out. So these midstream companies do a lot of things, right? So they'll help process and separate out the hydrocarbons into pure form so they could be sold at the right price. They'll provide storage, they'll provide shipping, and ultimately they can provide getting it to an export terminal or to a refinery or a power station. So yeah, I would say there's certainly, it's broadened. Some other people might think of it as including electricity, long distance power lines and things like that, which we don't invest in, but I guess that would be called energy infrastructure as well.
Interesting. Yeah, I read somewhere or seen a white paper on something about how the trucking and it was kind of going, my words, I don't know if it's right, more horizontal, I suppose, in terms of what really encompasses that whole process that you're describing. So I don't know, it's kind of interesting in my mind.
It's such a cool set. I've been invested in it for over 20 years, and it's just not really that well understood. And yet, the returns have been attractive over the long run, very attractive. Another thing people don't appreciate is there's this inflation link. So pipelines are very regulated, really, to avoid the pipeline owner from exploiting. Let's say there's a pipeline that goes between A and B, between 2 points. Probably you won't get a second pipeline, over that same area. Same as you wouldn't get 2 railroads, between 2 towns, right? And so the Federal Energy Regulatory Commission, or FERC, regulates price increases in order to make sure the pipeline owner makes a sufficient return on invested capital that he's going to keep maintaining the pipeline, but not an excessive one. And part of that regulation means that price hikes are prescribed to be related to the PPI. There's a spread, usually FERC adds a spread above or below that. But basically, when PPI is up, as it was 3 years ago, price hikes go through automatically. And people estimate around 50% of the EBITDA of the midstream business is in those kind of inflation-linked contracts. So and inflation's running at 3, not 2 now. And I'm of the belief that with our fiscal outlook, I think 4 is more likely than 2 in terms of inflation. And if you want investments that are going to protect your purchasing power, this is one place to look, because so many of these companies have this PPI link in there. And that was one of the reasons returns were so strong in 23 and 24, because those price hikes were coming through into EBITDA. So not a big deal today because inflation's obviously come back down. But, for the long-term saver, you want to, maintain purchasing power. And that is one of the ways to do that with pipelines.
See, these are the little details that, a lot of us don't even think about or remember. So let me ask you this. I know you get around, you meet with a lot of people, you travel quite a bit. I think that's probably an understatement, right?
Yes.
um,
I'm a 1K member on United. Yeah, that's true.
yeah, exactly. So go ahead and if I can put you on the spot and, maybe share some of the facts. Cause like I mentioned in the beginning, um, this sector is certainly a big part of our assets that we manage for clients. It's a huge component for most people's retirement. We like, for the dividends, for the outlook. I've got clients that stayed in, believe it or not, from 2014 who are still invested there. Sure, we realized some losses along the way for tax
Yeah, yeah.
benefits, but it's always been one of those things where I could tell people, in spite of as bad as things were getting, it always just made sense to me. And I can't say that about a lot. So if you're, sitting there and I know you've got resources and things maybe you want to share, but what do you say to people to let them know, hey, not only are we in a good place now, but the outlook from my perspective as a person who's been doing this for a long time looks really, really good.
Well, the thing is, you get paid to wait, right? Because you're getting that dividend, and a lot of people invest for the income, and I think that'll become more important again. It was, leading up to the pandemic and afterwards when short-term rates were so low, and it looks like rates are going to continue to come down. So the income component will be even more important. But I think it's the stability of the cash flows. I mean, I've told a lot of people this year, if these were private companies and we didn't have this daily stock price, what we'd have to do is just rely on operating performance, and operating performance is fine. Earnings are becoming fine. Third quarter earnings were, for the most part, no big surprises. Volumes are going up. We did record amounts of oil and gas output in America in August. We haven't had any more recent data because of the government shutdown. I assume we'll get some more soon now. So if you only had those two things, operating performance and volumes up, you'd say, wow, this sector must be doing really well. And that's the thing to focus on. So you don't use leverage, you don't borrow money, you don't try and trade. It's very hard to do that. And you just pick companies that you believe you can hold for a very long time. And so over the years, we've sort of, I guess, self-segregated, or we've found investors and investors have found us who share that philosophy. So our clients know, we're not going to be market timers. If you give us money to invest in the sector, you're getting 100% exposed to the sector. We're not going to sit here and say, boy, we're defensive, we're going to have 20% cash, and then all of a sudden it goes up and we only made 80% of the return. No, you give us money in the sector, you're going to get 100% exposed to the sector, 100% of the time. And it's a really simple approach. There's no derivatives, there's no leverage, there's no debt, there's no shorting. It's just, as they say in England, it's what it says on the tin. It's just what you would expect it to be, right? And I've been having a lot of those conversations with people in the last few months because I have been doing a good bit of traveling to go and see clients and investors and potential investors, because it's been a disappointing year, especially compared with where the S&P's been. And so, the low correlation means that when that turns around, we're not the complete solution for anybody's portfolio. I think we should be a big part of it, but not the complete solution. So when the market shifts from growth to value, when people decide that AI stocks are a great story, but maybe that's just gone too far, this sector will be there, and it's cheap, and it's just waiting for sort of capital to come into that. So I've been having a lot of those conversations. And I have to say, for the most part, because we've been doing this a long time, the investors that we have, they're expecting to hear that from me. That's kind of their mindset as well. You stay the course. It's worked for us for a very long time, and it will continue to.
No, that's kind of the lesson in life. I mean, I mean, really, with this stuff anyway, I've learned there's, obviously there's speculation, and some would argue that any investing is speculating, but there's quality, and then there's just garbage, but if you own things that make sense, I mean, and as you said, you just stick with it. At some point, things tend to work out for
Well, I
people.
like to own things that I can value. So, Bitcoin is as far away from me as anything could be, because I wouldn't even know how to start to value Bitcoin because it doesn't pay you anything. So, midstream is the complete opposite. There's visible cash flows. You understand where they're coming from. there is some exposure to volumes, but what's really extraordinary is how stable energy consumption is in America. I mean, we've used between 19 and 20 million barrels a day of liquids for years and years in this country, and it only dipped a little bit in the pandemic, of course, in the second quarter because you couldn't go anywhere. So commodity prices, oil prices move so much more than volumes. We pretty much drive and fly the same amount year after year. The population grows, the economy grows, that increases demand, but we get more energy efficient. Mileage improves on automobiles and stuff like that. And that's even true for electricity. And that's actually a very big issue. Electricity, unless you looked at it, most people probably think, well, I guess electricity consumption has probably been growing every year along with the economy and the population. And that's not true. Electricity consumption has been growing hardly at all, like 0.1% annually or 0.2, really, really flat growth.
Wow.
And now it's starting to grow at 5 or even 10 times as fast because of data centers, right? And so this is a huge challenge because in the electricity industry, they're used to moving really slowly. They're not used to the concept of time that data centers have and these hyperscalers is completely different. Utilities are used to meeting demand that they perceive. They do 10-year outlooks every January. They produce a 10-year plan of where they're going to be. And these data centers, like 10 years, boy, the chips that I'm using will be useless in 18 months. I mean, I got to get this thing up and running now because I got to replace the chips in 18 months because the new ones will be so much better. So that's there's a lot of pressure points on that with electricity. And at least we know we're part of the solution with gas, but that's going to play out. There's going to be a lot of sort of, political implications of that as well, because data centers don't create many jobs. It's a great big warehouse. Once it's built, it's got thousands of computers and a few IT guys walking around checking on them, right? There aren't really a lot of jobs that come with AI. There's the risk that people lose their jobs because of AI. I think that'll create other jobs, but not everybody is going to be a winner out of that. So there's a lot of issues with that. Electricity prices have been going up in a lot of the country because of the demand from AI. So there's going to be more political issues around AI. And is it really good for me, the average guy, or not? So we got that coming as well. And so the behind the meter solutions, with the dedicated gas line to a power plant that's just there for the data center, at least that avoids pushing up the price of electricity for that community or that system.
You brought up a point I was thinking too, before the election. So I guess about a year ago ish. And that is, it didn't seem to matter. And you kind of explained it with the demand, the constant, demand, or consumption. And that it didn't, I mean, with all these environmental restrictions that were going on during the previous administration, the value of the investment, I mean, it's just interesting how certain factors just are not influenced by outside forces.
Well, I think the big mistake that the progressives, the Democrats made on the energy transition, and I'm not a climate denier. I mean, I think we clearly CO2 levels are going up in the atmosphere. It seems quite likely humans are causing that. The consequence is more complicated. Climate's complicated, but there is some risk that this is not a good thing. But the solution is not to say we're going to run everything on solar and wind, because you cannot do that,
Right.
because they're not reliable enough and there's not enough raw materials to do that. And the mistake that Democrats have made is they've told people solar and wind can solve all of our problems with electricity, and they're the cheapest form of electricity we have. And then inconveniently, all of the evidence is the opposite. In fact, if you look at regions that have very high renewables all over Europe, which is steadily deindustrializing because they've embraced the energy transition so much, electricity is expensive. Britain, which relies heavily on wind, and it's a windy place, so not a bad choice, but it's very expensive. And so they oversold it. What they should have said is, 5 to 10% of our electricity will come from renewables. It's sort of opportunistic. When it is sunny and windy, they'll work, but we're not relying on them. and we'll do a lot more nuclear. Whereas the Sierra Club, for example, which is completely useless in terms of solving any problems that we have, is against nuclear. I mean, how stupid is that? So that's why the energy transition is slow, and why public opinion is moving very much against that, because the Democrats oversold what you could do with solar and wind. It is a niche. It should be a niche fringe source of electricity.
Yeah.
Honestly, over the long run, nuclear should be what we use. It's so well proven. The deaths per megawatt hour of electricity generation are lower with nuclear than anything else that we use. And so that's why the politics is sort of swung back. Well, I knew the physics was never going to allow solar and wind to be a dominant source of electricity generation. That was just so clear if you really studied it and spent time on it, and forgot about all of the hype and politicians saying, oh, we're going to do this. And yeah, sure enough, that's where it's come back. And that's why we focus on natural gas for a long time.
Well, you just answered the question of, because there's always one thing that I'm sure you hear a lot is, what about the green revolution? How's this going to impact? And, in fact, one of the recent interviews or podcasts you put out, you kind of got into that and you really showed the percentages and where consumption is. And, the truth is always a lot.
I have a great chart which I show that the only energy transition that's gone on in America is the natural gas energy transition. And if you look at actual volumes of energy produced, exajoules, which is the one that's used by the Energy Institute, the natural gas has increased at 8 times the pace of renewables. But people the proponents focus on the percentages. They say, renewables have grown by 10% or 15%, but they've grown from nothing. So anything, like a toddler who becomes 4 grew at a very high percentage rate, but they still didn't grow very much, right? So, natural gas in actual energy output has grown 8 times as fast as renewables. And that's true over the last 5 years, 10 years, 15 years, 20 years. That's been what's happened. So the natural gas energy transition is what has happened in the United States, over the last 15 years. And that has been to our enormous benefit in this country. And thank goodness that, the most extreme views on renewables never really got implemented in this country, because then we'd be looking like Germany.
Yeah.
So I always love to point that out to people. I mean, renewables they're always going to use them. We're going to use more. Energy transitions take a very long time. There's a fellow called Vaclav Smil, who's a terrific writer. You don't read his books in bed after a couple of glasses of wine. You sit there and make notes and really think about it. It's really intense. But he's sort of this multidisciplinarian. And he shows, for example, we've had energy transitions before. We went from wood to coal. And when coal went from 5% of primary energy to 20%, that took about 30 years. And then we moved from coal to oil. And that was another several decades. And then, oil to gas. And so the notion that we were going to suddenly, transition to solar and wind at a much faster pace than any of those prior energy transitions, it just didn't line up with any knowledge of history. And some of the forecasts even had us using less energy in aggregate. The world has never used less energy. It's always used more energy. As far back as we've got data, 2020 with the pandemic, it dipped modestly and back up again. And what you have is, in emerging economies, you've got people who want to have higher standards of living. And there's a chart I've got that shows on the vertical axis energy consumption per capita. On the horizontal axis is per capita GDP. And so basically, as people get richer, they use more energy. As they use more energy, they get richer. It's a very nice fit. It's a very good correlation. And America is up and to the right, and the world wants to get there. And most people are not living in the developed world. They're in the emerging world, and they're going to use more energy to raise living standards. And that's about as certain as anything could be. And so energy consumption has gone up in the world. That's the first thing. You got to figure out how to deal with that, because there's billions of people who want to live, they aspire to get closer to living like Americans, which is always going to take decades to do. And so there was never really a sufficient appreciation of that. And that's what's driving. And so I'm sure we're going to use more of everything. We're going to use more renewables, but we're going to use more of everything. We're going to use more coal, in the next several years. I mean, eventually we'll use less, I hope, but even coal is going up.
See, here's the thing. When I listen to you, Simon, that just seems like a reasonable, realistic outlook, which is why your view isn't on, the mainstream news every night. No, I mean, seriously, that makes sense to me. Of course, a little bit, everything, it's always, you know what? I'm sorry, I'm tripping over my tongue here, but it seems like the truth is always in the middle of the extremes. And what you say is just that actually makes sense.
Yeah, that's a good way to put it. That's a good way to put it. I mean,
anyway, so I got a question.
This is all we do. I mean, we try and know a lot about just one thing, because you can't really be good at too many things. Hopefully you can be good at one. And I spent a lot of time reading and studying this issue, and this has evolved over years. I mean, years ago, I really did wonder, boy, is this really going to knock us out? Do we need to think about investing in other sectors? Should we be looking at renewables? And the problem is that they never made any money. The cash flows were horrible, terribly reliant on government subsidies. And then the physics didn't work. That just was not going to make that. And then, I sometimes, when I do presentations and we talk about electric vehicles, and, EVs are growing, but slower than people would like. First of all, America is one of the least likely countries to have a lot of EVs for three reasons. We are a big country, so we drive a long way. We like big cars. 2/3 of private automobiles are SUVs and light trucks. And gasoline is cheap here. It's cheaper than any other developed country. This is the least likely place to have a lot of EVs. And I often think that, if we'd started out with EVs, and all of the range anxiety and the 45 minutes charging, and then somebody said, hey, guess what? I just discovered this internal combustion engine. 5 minutes, you're out of the gas station. We would have run to that. Oh my God, the tyranny of the range anxiety is gone. I mean, if we were going to use EVs, the way they should work is 95% of people's car trips are 5 miles or less, right? It's the 5% that you need. The EVs that we buy should be like souped up golf cars, kind of what the Chinese are selling, because everybody who owns an EV has another car. I've never met a single EV owner who fully relied on that, because if they're going to go 150 miles, they want to know they can get back.
Yeah.
They're not worrying about that, right? That's what it should have been. But of course, we don't want the Chinese EVs. So, I mean, Ford trying to build that, the light truck EV, I mean, what are they thinking of? I mean, Rivian, Rivian may be like, Rivian have a truck with a slot for golf clubs. Okay. Now I play golf. There's not many trucks parked at golf clubs. That demographic doesn't have a lot of overlap. But you do have people who are making a political statement, and most EV buyers are making a political statement. So you got those people, and they play golf because they want a place to put their golf clubs. I mean, this shows what these companies are trying to do, and that's why it's all been a big bust. So there wasn't any sort of realism around that. Now, I'd buy an EV, if I was going to buy an EV, which I don't have one, I'd buy a $15,000 EV to run around town for the 95% of trips that are short. And then I'd take a nicer car to go on a long journey. And that's how we should be solving the problem. But that's not, the auto industry has said, well, we need to create a car that is your complete transportation solution. And, until they can get the charging down to 5 minutes, I just don't think they're going to do that.
Yeah, I tell you what, I'm from that. I grew up driving a manual shift.
Yeah, me too. In England, yeah.
Yeah, and I'm fortunate to have a couple of sports cars now. For one of them I call the company car, and another one that's just my not retiring gift, and that's 715 horsepower. And I'll tell you what, there's nothing more beautiful than listen to that thing rev up. I'm sorry, forget about the. I mean,
yeah,
and
of course, I get that.
In fact,
I understand
you're
that.
from Europe. I remember one of the coolest memories. My son and I were in not Finland, Iceland, Reykjavik.
Oh, yeah, okay.
And yeah, we'd gone on a trip to Greenland, and we're sitting, and we're the last day there. We're all out with the people, getting ready for the last dinner and everything. And all of a sudden, you hear this rumbling. This is in Reykjavik, Iceland, and I turn around, and there's a row. I mean, like 20 or 30 American muscle cars from the '60s and '70s, and it was just the coolest thing you've ever seen, right?
Yeah,
That
I
you know what I
bet,
mean?
I bet.
And, yeah, so I think, I mean, this is all this practical stuff, but I just think, at the end of the day, driving I mean, I know we're going to go off tangent here, but I mean, it's just something that's, to me, that, I would never want to lose that. This thing of driverless
Because
cars and
it's
all
a
this
big
stuff.
place. Once you get out of an urban area, this
Yeah.
is a big country. I mean, people do 15,000 miles a year on average,
Yeah.
right? That's more than most countries in the world. Maybe Australia's similar, but obviously a lot smaller population. So they're going a long way. I mean, in England, if you drive 100 miles to see somebody, you're staying overnight. There's no question.
Hmm.
In America, people will do that. They'll go 100 miles, it'll be on the freeway, and it'll be rolled out, and all the traffic, and they'll drive back, at the end of the day. So it's a different sort of way of life. Europe's much more densely populated. The cars are much smaller. I mean, we were in Rome in September, a couple months ago. I mean, they have EVs there that you could put in the back of a truck, like a light truck that somebody would own here. You could toss in the back of a Ford F-150.
That sounds awful.
EVs that hold one person. But it works, it's all these really old, narrow streets, and it works for them. So the US
Smart
is one of the least,
cars.
right?
Yeah.
Yeah.
So, hey, one last question, Simon. Gosh, I enjoy this. Last question. Just, I'm curious. I mean, of all the things you could have done in finance, managing an equity portfolio, or doing some quantitative analysis work, or maybe a hedge fund, how did you end up in the energy infrastructure space?
Oh, well, so I ran foreign exchange and interest rate trading in New York for JP Morgan and then predecessor banks. And I sat on a hedge fund investment committee. We allocated money to some of the biggest hedge funds. And so I got exposure to being a hedge fund investor. And from that, I started a business investing in new hedge funds. And I wrote a book about it, The Hedge Fund Mirage. So I was like a seed capital, venture capital investor in hedge funds. And so when you do that, you look at every possibility. And I met a hedge fund called Alarian Capital Management. And I'm sure
Yeah.
with MLP and its benchmark. So I met the guys. I didn't know what MLPs were. And I met a young guy called Gabe Hammond, real smart guy. And he explained to me what the sector was like. And so we wound up investing in his hedge fund, his offshore hedge fund. Worked out really well for our clients. And I found the sector so interesting because I was able to see everything they were doing. And so it's not obvious how I would wind up there, but I sort of embraced that. I'd researched it. I started investing my own money. That was 20 years ago. And then I left JP Morgan in 2009. So about 4 years after I invested with Alarian, and I had a portfolio of MLPs and I just kept managing it, and the business sort of grew out of that. So it sounds a little unlikely, but there are sort of logical steps along the way from, being FX and fixed income and then on a hedge fund investment committee and then to MLPs.
Well, definitely more interesting than managing bonds.
Yes, that's right. Although, bonds, they were more interesting in the 80s. I mean, I wasn't really doing that from the late 90s and through, the great financial crisis. I mean, interest rates barely moved from day to day. And I'd look at it and I wasn't trading that and think, oh my word, what would I be doing? Like a 2 basis point move would be the thing of the day. So yeah, I'm glad I wasn't in there. But in the 80s, the stock market crash in 87, enormous moves. And after that, so yeah, I was doing it when it was interesting and when it was a bull market. And then I moved on, as it turns out, when it became kind of boring. And now it's all, my old job wouldn't exist. I mean, there's all young software engineers doing trading now, right?
Well, I've enjoyed the conversation. It's always nice to talk to people with a lot of experience in the industry, and particularly in a sector that, I know enough about to at least have a conversation. But
Definitely, yeah. Well, that's been my great pleasure. I'd love to chat to you too. It's been really fun.
No, thank you. And again, just thanks. I think if anybody's listening to this, that, that are investors in the sector, you can come away feeling confident because you bring like I mentioned before, just a realism and a kind of a, there's an underlying confidence that it comes with your experience and what you shared, and I think that's good because
Thank you.
yeah. So anyhow, just appreciate your time. Have a great weekend, and thank you for joining me.
And you, my pleasure. You take care. All the best.
Emerson Fersch is a registered representative with and securities offered through LPL Financial, member FINRA, SIPC. Advisor services offered through LPL Financial, a registered investment advisor and separate entity from Capital Investment Advisors. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. The guest speakers and the companies they represent are not affiliated with or endorsed by LPL Financial or Capital Investment Advisors. Individual tax and legal matters should be discussed with your tax or legal expert. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.